right at the moment. So I do believe we're live on Zoom.
Jonathan, I'm in a Zoom right now. I can't talk.
Okay, I'll call you later.
All right, bye.
Yeah, we're live, buddy. So, what's up, Bill?
Hey, how are you?
Doing good, man. How about you?
Not bad.
All right. So, I got talking with you a little bit, with emails, and you told me about this gentleman that's like flipping houses or something like that. And I gotta say, man, that really interests me. It kind of floats my boat. I know a lot of people that like to flip houses, or they'll do like the BRRRR strategy where they'll buy, rehab, rent it out, refinance, and then repeat. How can infinite banking help when it comes to that?
Well, this particular guy wasn't really flipping. He owns 17 properties. One of them he lives in, so 6 of them are rentals. What he was doing was using, well, like everyone else, it was going to take him 30 years or 28 years to pay everything off. But once we showed him how he could become his own banker, I mean, it didn't get him under 10 years, but it got him down to 15 years and saved him, almost $800,000. And what he was doing, he was just using the cash flow that he was getting instead of putting it in somebody else's bank, he was just putting it in his own bank. We call it a bank, but he was becoming his own banker. So he was more in control.
So basically, a lot of people that are in that situation, they'll just use what they have in the bank. They'll, put, let's say $100,000 down on the house, they'll fix it up, and then whatever comes back to them goes back into the bank. And so whatever they have there then is pretty much taxes, and they have the interest that's been avoided because they use cash. But in regards of using infinite banking, how does that help exactly when it comes to like saving the money? Because I understand, when it comes to like, well, I'll let you answer. I'm sorry.
Well, to use your example, a lot of times I get that question because we deal with the group, they're real estate investors, and they always say, hey, I use my own money. It's the best way to go. I use my own money. So I'll always ask them, well, if you had $100,000, I try to keep the numbers round so I can do them in my head. If you had $100,000, and I use an example of a gentleman right near me in Sunrise, who in Sunrise and Tamarack is where he buys properties. And his story was he takes he had like 200,000 in his bank, in his own, in somebody else's bank. So he would take $100,000 out. He would buy the property for $80,000 and fix it up for 20. Those were his numbers generally. That's about what he spent. 80 to buy it, about 20 to fix it up. So he had 100,000 into it. And I asked him, well, what do you see? He said, I sell it for like 120. So I usually stick with that example. Bet 100,000, sold it for 20,000, and I'll ask him, what's his return? People say, oh, 20%. That's what it is. I said, okay, but how many of those could you do in a year? Some people will say 12, some people will say 3, 4. So usually we settle on 4. So, okay, so if he had 100,000, he did that 4 times a year, he made 80,000. What is his return? And everyone says, well, if they can figure in their head, well, 80%. So I'll always ask them, well, would 5 times that be better? Would 400% return be better? Well, yeah, well, of course. Well, would 10 times the return be better? 800%? Yeah. How about 20 times the return? 1,600%. Would that be better? Oh, yeah, yeah. And they'll usually ask me, well, show us how. Show us how. And my answer is, you're asking the wrong question. The answer is not how. The question is not how, the question is when. When you become my client, I'll show you how. But the principle is you need to stop thinking like a borrower and start thinking like a lender. And how do banks use money? They will use your money. Sometimes you even borrow, you put money in a bank and you borrow the same money from a bank, and they'll make up to 2,000% return using your money and loaning it to you. So when people tell me, oh, I can get 10% in, Vanguard or one of these other deals, yeah, that's, it's a good return, but it can go up and down. Well, becoming your own banker, it doesn't go up. The only way it can go down is if you make a bad decision doing real estate or something. But if you know what you're doing, that won't happen because you're not using your own money.
Okay. Can it be used like for creative financing?
In what respect? What do you mean?
Well, basically, I know that when people are like buying homes, sometimes they'll get to that max when it comes to their credit. So they're not able to necessarily borrow from the banks again. So would we be able to borrow from like your policy to go ahead and like buy a home? How would that work?
Yeah, I mean, we have some people, it takes a while to put a substantial amount of money in there to buy a home, unless you front load it. But certainly a lot of people come to us to eliminate their debts. And in a few years, they've eliminated their debts. They might have been renting at the time. Well, now they want to buy a house. So what they'll do is they'll use the cash value in the policy and they'll borrow against it. And that'll be their down payment. A lot of times they get concerned because they're afraid the bank's going to say, oh, well, you're using borrowed money, but it's not considered borrowed money because you're just collateralizing the money you already have. So that's one way of doing it. And certainly, yes, real estate investors generally will front load a policy. What that means is putting more money in the early years so that they can use it to finance their business. Now, you had asked me, and if you want, I can show you quickly that gentleman that does have the 17 houses. I need to share my screen to show you the slide if you want to do that. But
yeah, that's fine as long as you're not giving away, detailed pertinent information on him. I don't want to get him in trouble or you in trouble.
No, I've taken, when I show these, I, take the person's name off.
So yeah, let's see some numbers here. Let's see how this works out. I'm curious.
Okay, so let me see. Okay, I can get my screen. So let me share it. Let me shut this down and open it. Just give it a minute. Okay, so you can see this, right, Stefan?
Yep.
Okay, so this is a report that we run if people have debt. If they don't have debt, it's a whole different ballgame. But this person, let's take a look. He had 17 hot properties. One was his own, and these were properties that he owned. Okay, and we funded his bank with $7,500 a month. So people go like, that's $90,000 a year. Where could I get that money? But obviously he had these properties and he had cash flow. So instead of putting this money in somebody else's account, some other bank, he just took the money and put it in his own bank, which was the cash value part of his life insurance. So you could see it was going to take him 29 years to pay all these debts off. I'll go to the next page. It'll make it a little easier to see, but he owed $2.5 million. That was his mortgages, $2.5 million. But he was going to pay 4.3. So let's just take a look. This is what he owed. If I asked him, that would have been a total he gave me. This is what he was going to pay back. And here's the problem. It doesn't matter who it is. It's always the same problem. It's the interest. He's going to pay $1.8 million. So what we did, instead of him taking 29 years, using the same money that he was It wasn't additional money that he took out of his pocket. It was just money that he was putting somewhere else. We redirected it into his own bank, his life insurance policy. And we took him from 29 years down to 15 and a half years. And he saved $800,000. You know, how did he do it? Well, in 20 months, he had enough money to pay off this first property. It originally was $84,000. 20 months later, he had it down to 82,000. He had enough money in his policy, took a loan, paid it off. And then the mortgage payment, which at the time was $425, he basically took over the mortgage of his own property. So what happens is, and it's hard for people to think like this, they're wearing two hats. They're the investor and they're the lender. So I hope that answers your questions. If you have any more, you know, I can show you, but you could see in a matter of, well, just a little over 10 years, he had half the properties paid off. You know, and let's just look here. He's putting on top of the $7,500. Now he's putting those mortgage payments of $5,300 into his policy, and it starts to go quicker, you know, as he goes down the road.
That's pretty cool. You had other illustrations. I mean, basically, Bill is able to help you guys when it comes to this. I mean, each person has their own individual situation, obviously, you know, so you had shared some other things with me that, you know, I'm not going to ask you to share here, but when you look at like the math behind it and you look at how you can save money on the taxes, how you can save money on the interest, and how you can wear those two hats, it's amazing. I mean, it's just like, wow. You know, when it comes to like, you had said something about the collateral, you could use the money as collateral. I've heard it, you know, before online where, you know, people say, oh yeah, you can use, you know, the money as collateral that you have within your insurance for a typical bank loan. But that would be not recommended, because if you have your own bank, you're making more money that way, right?
Yeah, well, you know, it was funny. I did something at my church last night, and one of the gentlemen that was, you know, he comes to the meetings, I was presenting, and he said, well, my neighbor was telling me he was going to refinance his house, take the money out and invest in like Vanguard. And I said, he said, would you recommend that? You know, and I really can't make recommendations. I don't know the person, but just generally speaking, hypothetical, without, you know, just if you ask me that question, I'd say no, because you're taking money out of your home, which is never a good deal. You know, if it was something else, that's different. But what happens is, if he's going to refinance his house, he's going to put it in Vanguard. And he said, well, he can make 25% return. I said, yeah, but what happens if he doesn't? What happens if he loses the money? Because that can happen. But I said, you know, he kind of fought me on it a little bit. I said, okay, let's say he could make 25%. Do you know what the cost is to refinance that mortgage? I know they tell you the annual percentage rate is 4% or 5% or 6%, whatever the rate is. That's just the selling point. They call it APR, stands for annual percentage rate. I call it the average person's ripoff rate. Because if you really run the numbers, the first 5 years, including closing costs, he's going to be paying 86% of his mortgage payment is going to interest. So why would you pay 86% to get at money to make 25% and possibly lose money? Yeah. You know, there's better ways of doing it. That is the traditional thinking, and you got to get away from it. Very simply, I'll try to make this brief. You put $30,000, you make a deposit at a bank of $30,000. It's really a loan. You've loaned the bank your money because they're going to loan it to somebody else. Let's assume that you go to the bank and you borrow $30,000 because you need a car. I hear it all the time. I'm not going to use my money because that's my safety net. I want to keep that there. I'm going to take a loan. So you have $30,000 there. How much are they paying you in interest?
Like 1%.
Well, the average right now is 0.4. 0.4. So if you have $30,000 in that account, 0.4%, they're going to pay you $120. And I just did a video on this. That's why I know the numbers. Just posted it last week. So you're going to earn 120. They're going to pay you $120. Let's say you go to the same bank and they loan you $30,000. Pick a number. What interest rate do you think they loan you money? Give me a number, Stefan.
5%.
5%. So if you borrow the money at 5%, you're going to pay them $1,500, correct? So what is the bank's cost in this deal? What is their investment? Because that's how you figure $120. So you take the $120, divide it into $1,500, and what is it? It's 1,500% or 1,200%. Let me take a quick look here. 1,500 divided by, I should know this, I just did it. 1,250% return on your money. But they were nice enough to give you 0.4%, but they just made 1,250%. When people run the numbers and stop listening to guys like me that are or financial advisors and run the numbers themselves, I'm not saying financial advisors lie or I lie or other people lie, but numbers certainly don't lie. And if people would just start running the numbers themselves and then get advice based on their numbers, they'd make different decisions.
So you also help people. I thank you for that. When it comes to, like, let's say the other end of like real estate, for those who may be lending out like hard money. Let's say if I had like $100,000 and I'm going to go ahead and lend that out, how would infinite banking be able to help me in that situation?
If you were a hard money lender, you mean? Well, for example, right now, and again, I did something like that in a group. I also have. I mean, maybe next time I can show you the slides. But let's just run the numbers. $100,000. At the time when I did this, they were loaning money at 12%. It's probably lower now. Let's assume it's 10% now. I just pick a number. So if you got $100,000 and you loan that $100,000 out at 10%, you're going to end up at the end of the year making $10,000 or whenever they pay you back, however often. But let's run it annually so we can pay. So you just made $10,000 return. How would it benefit a hard money lender? They always get shocked when I tell them this. Your money can do two things. You can essentially use your money twice. Right now, the way we traditionally do it, we use it once. We either borrow the money from somebody or we use our own money. But if you are your own banker and you think like a banker doesn't use his own money. They don't even have money. They use everyone else's money. So if you have your money in a life insurance policy and use it as collateral, you're going to get that. You're going to borrow the money from a life insurance company. Same situation. He's going to pay if he took $100,000 loan, let's say his cost is going to be 5%, but it's 5% simple interest. So if he loans the money out, $100,000, he can take that money out. He's going to make interest and dividends on the money. He's got to pay $5,000, obviously, in interest, but he's going to get $10,000 also. So he's using his money twice in that instance. And when you really run the numbers, you make more money doing it that way. And I've showed hard money lenders, and they look at it and they go, I should be doing this. But every case is different.
Yeah, if you're up for showing numbers next week, if that's up to you, maybe we could kind of, do me as a scenario, at my age and all that kind of stuff. I don't know. But I'm sure that would be of interest to, some of the people out there. Because, a lot of the people that I've been interacting with a little bit is like mortgage brokers and real estate brokers. We had, people that are in financing. And so basically, obviously, they deal with money on a regular basis. But infinite banking is something that is different than the traditional banking. So a lot of people are unfamiliar with it. And that's one of the reasons why it's like, wow, this is just awesome, because of the benefits that it has. I don't know, anything else, Bill?
Well, let me just make a point on what you said. If you deal with money lenders, mortgage brokers and real estate brokers, what we do when I speak to them in general, you can really help them. And both of them are in the same case, whether we take a real estate broker, a real estate agent, or a money lender, people come to them and they want to be shown a property. Maybe they're renting, so they want to be shown a property. Well, let's say their debt to income ratio is too high. So the real estate agents, they don't want to be a Uber driver driving a luxury Uber driver driving them around in houses unless they know they can qualify. So they send them to qualify. Now they come back, they can't qualify because their debt to income ratio is too high. What happens to that client? They walk away, never to be seen again.
Yeah.
And I tell them, if you can send that person to me and say, look, I have this guy, he can help you. They're not going to come back next month, but we can fix their credit. If it's credit cards, usually in a few months, we have their debt to income ratio at a higher rate. So what happens now? When I'm done with them, who am I going to send them back to? I'm going to send them back to that real estate agent or that mortgage broker. So now they're going to do the deal. What's the chances that, well, what happened is they recaptured a lost commission, but what are the chances that that person has friends that also rented, that also wanted to buy property, and they're going to come and they're going to go, Stefan, how did you buy this house? You were worse off than me. I went to see this guy, he showed me. And so what happens is they now have an opportunity to get additional clients because, word of mouth. Once you help one person, you could advertise all you want, but as my dad used to say, the proof is in the pudding. Actually, the proof is in the eating, is what he used to say.
That's good. So it can help out the realtors, it can help out realtor brokers, it can help, I mean, there's so many different applications, which is awesome. The book that was by Nelson Nash, he went into talking about how it can help out like a trucking company. And you think about just even like if you have rental vehicles that you're using for your own company right now, I mean, it can help out when it comes to that. There's just so many different applications. It's mind blowing.
Well, you know what it is, Stefan? People talk about all the time the rate of return or the interest rate. Infinite banking is not about rates of return. It's not an investment. It's about controlling the banking function in your life. And if you can control the banking function in your life, you'll control the flow of money. Instead of going to a third party away from you, you will buy the debt from that third party, and you'll be making the same payments, but you'll be taking them out of your left pocket, putting it essentially in your right pocket. Right now, you're taking them out of your left pocket and you're giving it to somebody else. The things that are needed to do this, though, because I have people call me all the time, first main thing is discipline. You need discipline. If you don't have discipline, don't bother. You're going to waste your time and money. You need discipline, you need desire, and determination. The 3 Ds. If you have those 3 things, then we can help you. You're not going to take money out of your pocket. We're just going to show you how to use your money more efficiently and redirect it better for you, better for your family. Because if something does happen to you, your family is going to get a death benefit. Right now, using your own money, they're going to be left with, say, half a built, renovated property, and whatever's left is taxable. And then they got to pick up the pieces. Unfortunately, I just had a client pass away like 2 weeks ago, and the wife said to me, she goes, if I didn't have this money, I'd be in a world of hurt. She used different words, but she said, I wouldn't know what I'd do. So that's the side benefit. If people would just take the misconception that they have of life insurance, infinite banking is a very simple process, but they try to complicate it. They look for the gotcha. This can't be good. This can't be true. But if they just think of it like a bank and use it like a bank, it will certainly change their life. And the thing I like about what I do, everything I do is guaranteed. The hard part of what I do is trying to get people to make a paradigm shift in their head, to believe the numbers, but the numbers, they're right there on the paper. You know, all they have to do is follow the plan.
Man, that's it. Bill, I thank you very much for your time today. It was pretty cool. I look forward to the conversations we're going to have, because I mean, I know that this will help somebody down the line, you know, and you know, getting to know, you know, the different aspects of how it works and how it can, you know, impact, you know, you in your individual life, you know, and your family circumstances. You know, for me personally, how I look at it is it's kind of like the foundation when it comes to your finances. You know, so you have like your finances, and then you're able to, you know, use this as, like you said, as a bank. And then down the line, you know, if you want to go ahead and do like the investments, or, you know, go ahead and, you know, do other type of things that will, you know, build your portfolio. Awesome. But you'll always have like that, I wouldn't call it a nest egg, but you'll have that platform that you can always use, you know. So got a lot of background noise in the background, so I apologize.
That's your partner. He wants to come in. He tells you, be quiet.
Yeah.
They know you're real. They know you're real. So,
Yeah. Well, let's do this again next week.
all right. I'll see you then. You have a good day, my friend. God bless you. Bye-bye.
Bye. Still live.
Hey.
Hold on.